Good afternoon, class. As you got from the email, we're not going to be able to meet tonight. I am really feeling under the weather. So this recorded lecture will um, replace our actual meeting in person. There will be an attendance question as part of the lecture. During the lecture, you'll be asked to answer a question and email me it directly. Please do that, and you'll count as having attended tonight. Um, I've posted the slides for this lecture online, so please pull those slides up for class 2 and read along. I'll reference the slides that we're on. In addition, I have posted the answers to the review problems for class 1 online on Campus Web. Please do that and review those answers. That should help you. Tonight I want to try to get through the material as best I can. I am really not feeling well for chapters 4, 5, and 6, and also deal with the review what you need to know for your assignment. So why don't we just sort of get started. Again, please review the review questions, answers to the review questions that I've posted, and email me the attendance question after you listen to the lecture. So tonight we are dealing with chapters 4, 5, and 6, which are payments between landlord and tenant, sales and dispositions of leases, and improvements and additions to property, how you deal with the tax consequences. Then we're going to go over the review problems for this chapter, and I'll briefly explain the review problems for this chapter, for this class, and then I'll post the solutions to those next week. Slide 3 just references that the review problems have been posted. The answers to the review problems for class 1 have been posted, so you want to make sure you do that. Slide 4 on lease acquisition, that's part of chapter 4. Lessor and landlord and the lessee and the tenant. When you have a lease situation, obviously the tenant is paying rent to the landlord. That's gross income for the landlord. Rent is typically for the use and occupancy of the property. When rent is paid and services are included, the fair market value of the services are also income to the landlord. You want to make sure that when you're looking at a lease transaction, it's a true lease. In some cases, the IRS will recharacterize what is on paper a lease as actually a purchase. And the reason for that is simple. A rent supports an immediate deduction to the tenant, whereas a payment for a piece of property supports no such deduction. And to the extent you can make a lease sound, or make a purchase sound in a lease for a few years, you could get the additional benefit of acquiring equity in the property and also obtaining a deduction for rental payments. Okay. Slide 5. Rent is sometimes represented as a percentage of profits. Commercial lease agreements based on a percentage of lessee profits are income to the lessor and deductible to the lessee as long as the parties are not related. Where there is a case of substantial reduction from year 1 to next, the court held that so long as the lease is fair and reasonable at the time, then the deductions from the rent paid during the term will be upheld. It's typical in lease transactions that you have a triple net lease. A triple net lease is where the tenant pays for real property taxes, utilities, and insurance on the property. In those cases, that sounds a lot like ownership. So the question then is, what do you do with how do you treat from a tax point of view the payments that the tenant makes for taxes, utilities, and insurance. Such items are treated as additional rent to the landlord and deductible by the tenant. Pursuant to Internal Revenue Regulation 1.162, I'm on slide 6, taxes paid by the lessee for business property are deductible to the lessee and income to the lessee. In residential property taxes, in that case, the item is not deductible to the lessee, but it's additional rent that produces both income and a deduction. Reclassification of rent. A seller sold his property for less than fair market value to buyer in exchange for free use of part of the property after the sale. The IRS concluded that the free use was additional consideration. In the sale leaseback, I'm on slide 8. In the sale leaseback context, a court held that the sale of property to a buyer who improved the property then resold it to the original seller at a loss was in fact a lease situation. The buyer's loss was reclassified as rent, deductible to the buyer and income to the seller. Business property leased between family members presents a section 1 related party 267 issue. In that case, 267 may disallow a loss on payments between related parties or require that the deduction and income from a 267 transaction occur in the same taxable year. Business leases between related parties must be fair and reasonable. Excess rent will not produce a deduction if it is greater than the fair market value. Similar scrutiny applies in 267 transactions between controlled corporations and their parents, and controlled corporations and their shareholders. Like I said, you need, as far as the tenant landlord relationship, under 267A2, deductions and income must be between related parties must occur in the same year. Therefore, related parties in a lease agreement must incur income or deduction in the same year as the respective deduction or income is incurred. There's a good definition of who related parties are at page 132 of your text. As far as the tenant's rent deduction, rent for use of business property is deductible. Rent that is personal, living, or family expense is not deductible. A lessee using the accrual method deducts the rent for the year in which the rent accrues. Advance rents. Advance rents are kind of a situation in which the IRS really has a harsh rule. If I'm a tenant and I pay rent in advance, maybe as an incentive to obtain the lease, I am not entitled to an immediate deduction for that expense, even though financially, myself individually or my company does not have access to that money. The IRS says I'm paying for the future benefit of the asset, and therefore I'm only entitled to that part of the advance of the payment which is attributable to usage of the property in the current year. On the other side of the transaction, a landlord is required to recognize all the advance rent, even though it's for the usage of his property in future years. He's required to take the entire advance payment into income in the present year. You have a certain tax asymmetry there, where it's unequal rules on both sides of the transaction there, and a clear difference between the financial accounting rules that would apply and the tax accounting rules that do apply. Okay, I'm on slide 13. As for the landlord's rental income, the cash method lessor includes the rental income in the year paid and the accrual taxpayer in the year accrued or received, whichever is earlier. When a lease calls for rent based on a percentage of sales. An accrual basis, lessor includes the rent as income in the year of the sales, even if the payment is not required until the next year. Again, you have the tax asymmetry principle here as far as advance rents. Okay. Moving on to, skipping forward to slide 17, lease acquisition and disposition. The general rule here with lease acquisition is any expenses that were incurred, little e expenses that were incurred to obtain a lease, are typically going to be required to be amortized over the life of the lease. Similarly, when a landlord is paid, as a termination payment of the lease, that's really a payment for in replacement of future income, and that's going to be all income in that year to the landlord. As for lease acquisition costs, however, lessee and lessor must amortize, like I said, over the cost of the lease, over the term of the lease. Lessor's costs in managing the property and collecting rents are normally deductible under 162. However, the cost of acquiring a certain tenant must be amortized. Any payment that can be characterized as made to acquire a lease is amortizable over the life of the lease. Moving on to slide on page 18. A lessee who receives payment for modifying a lease realizes income. The question is whether the income is ordinary or capital. That will depend on the nature of the lease in the hands of the person receiving it. Leases are capital assets typically. If a holder of a lease or a right to use property sells it, if it's held in the trade or business, it might be a 1231 asset. Okay. I'm on page. I lost it for a second. I'm on page slide 19. This is your attendance question and your research problem, which will, if you answer the research question on slide 19 and email it to me, I will know that you have listened to this lecture and you will have done the work necessary to be marked down as having attended tonight. So please review the research question, the attendance question, and email it to me by next week. The attendance question is as follows. A corporation currently leases a building to B corporation. The remaining term of the lease is 5 years. C pays B $10,000 to assign the lease to C so C can occupy the leased building. Does C have a deduction for $10,000? And if so, how much and when may C take the deduction? Okay, pretty simple stuff based off of the material that we covered so far. You want to take a look at chapter 5 as far as lease disposition goes. I think you'll be able to find the answer. Shoot me the email and you mark down as having attended. That way you get the full credit for this lecture and experience. Okay. On slide 20, we deal with the situation where a lessor agrees to take over the lease when he purchases property. So I'm looking to buy a piece of property. The property is currently under lease to a tenant. When I acquire that property, how do I treat the amount I had to pay in assuming the lease? Is the payment on the assigned lease by the lessor a deductible expense or an acquisition cost? Lease acquisition costs are not deductible but must be amortized over the term of the lease. And there's a revenue ruling 68-260 which disallows the loss from the sale of stock and fixtures required not to be amortized. What if I'm on slide 21, what if you are unsuccessful in obtaining the lease? If your effort to obtain a business lease is unsuccessful, they'll be deductible when it's clear that the lease will not be acquired. But if it's attributable to another lease, then it must be amortized over the life of that lease. Some costs incurred by the lessee to acquire the lease may be deducted so long as they're attributable to improvements on the leased property with a life shorter than the remaining lease term, in which case these costs are recovered through depreciation deductions over the useful life. Lease cancellation, there's a very good case on that in your text. It's provided at page 153, the Hort case, where the landlord receives a payment in cancellation of the lease, regardless of the fact that the landlord may have costs. The total amount is characterized as a payment in lieu of income, which is treated as completely income. It does not allow for the recovery of capital in that transaction. So please review the Hort case, very important case in this area of the law. The lessee might be entitled to a deduction for the lease cancellation payment. It's deductible expense, the timing of which is dependent upon the taxpayer's accounting. Like I said, I'm on slide 24. The total amount received by the landlord in cancellation of the lease is income, based on the Hort case. Security deposit retained. The security deposit retained may also be income. On slide 25, we're talking about the reverse of the situation, where the landlord is making a payment to the lessee to terminate the lease. Landlord may have a more profitable tenant lined up. Those payments for cancellation of the lease are treated as the acquisition of property rights, and therefore they are capital expenditures. Therefore, the landlord does not get a deduction. The landlord has to amortize that acquisition costs over the remaining unexpired term of the lease. So, if you have a 10-year lease and the landlord buys out the tenant in year 4, then the cost of that buyout is amortized by the landlord over years 5 through years 10 of the unexpired term of the lease. If, however, tenant or landlord did the buyout in year 4 and replaced the tenant in year 5, but on another 10-year lease, then the cost of that is amortized over the 6 years remaining, or is amortized over the 10-year term, not the 6 years. Amounts received by a lessee in termination of the lease are an exchange, so the lessee has a recovery of capital situation there. Whether it's long-term or short-term capital gain depends on the application of 1241 in the Internal Revenue Code. So you want to take note of that. And in the case where you have a tenant trying to characterize the income to the tenant. If there's a cancellation of the lease and there's unamortized costs, the lessor's unamortized costs become fully deductible in the year of cancellation. The lessor is typically entitled to depreciation deductions on the property because he's the owner, right? Except where the owner does not have any depreciable interest, where he has no benefit to the use of the improvements or didn't pay for the improvements. On the other hand, the tenant is not entitled to depreciation unless he incurred capital expenses for the improvement. A lessee who rents improved property has not made any investment in the improvement is not entitled to depreciation, except when he does make any capital expenditure, he has to depreciate those improvements over the useful life of the property. Requiring a lessee to return the property to an original condition could endanger the lessor's ability to take depreciation deduction from the property. However, if the lessee is accepted from an obligation to repair ordinary wear and tear, then the depreciation deduction is applicable. Okay, let's take a look at some of the fact patterns for the review problems, and I'll talk about some of the issues that you need to look for there. I'll post the answers to these next week. You'll have enough to do with your assignment, which we'll talk about. And so you don't need to worry about necessarily the answers to these right now. They're not. This material is not covered under the assignment. We'll go over it next class. But I just want to briefly go over some of the issues just to make sure you're spotting the issues that these fact patterns bring about. So in fact pattern 1, we have H inheriting the building from D. D's adjusted basis is 100,000, while the fair market value is 150. If T, a tenant in the lease, pays H 120,000 to cancel the lease, what are the tax results? So there you're dealing with the situation where you have the court case. You have to deal with the problem of payments and cancellation of the lease to the lessor, the income issue, the characterization issue. How do you deal with that? To what extent does T have any expenses or losses that they can take based on that acquisition? Okay, that's fact pattern 1. Those are the issues related to fact pattern 1. Fact pattern 2, you have another lease transaction. This again goes to the materials in 4 and 5. Tenant leases property from landlord for 5 years. In year 2, landlord pays tenant a lease termination fee, and the lease is terminated since landlord has found another party who will pay rent. So this is the opposite of the Hort case. This is where the landlord is doing the payout. What do we have here? What is this transaction? What's the characterization to the tenant? How does the landlord get an immediate deduction for reacquiring it? If not, over what period is it amortized? How do we deal with those issues based on this fact pattern? Then you have a very long fact pattern that we'll go through in fact pattern 3. I'll just go over some of the issues. You have the New Cape May Hotel. It's leasing real property from taxpayer on a 10-year lease for a total rental price of $600,000 at $60,000 per year. However, under the lease, New Cape May must pay $120,000 to the taxpayer on January 1st, and the rent for the last year of the lease is subject to negotiation of the parties. In addition, the lease grants New Cape May the right to repurchase the property with a $60,000 down payment. Taxpayer had unrestricted use of the $120,000 paid by New Cape May, invested in interest-bearing bonds, and didn't hold it in trust or escrow. So that's the fact pattern for fact pattern 3. It's on slide 34. There's a lot of issues, right? You have an advance payment of rent issue. You have the issue that this looks kind of like a installment sale situation, because it looks like there would be really no reason to pay that rent in year 10. You would almost always make the payment to go on the purchase price. So are these payments really lease payments that support a deduction, or is it just part of a purchase price? If there are lease payments, they do support a deduction. If they're really part of a purchase, then there's no deduction for New Cape May. All right, so there's many questions on that fact pattern that we'll walk through next class. And let's just go ahead and talk a little bit on slide 38 about your assignment. Slide 38, last slide. So your first assignment is worth 15 points. It's posted to Campus Web. It'll go live tonight at midnight. You have from midnight tonight when it goes live until next Tuesday at noon, I believe, to complete it. It's all completed online. It's 5 short answer questions worth 3 points apiece. It's it's a problem on the at-risk rules that we discussed in Chapter 3. Please go back and review those rules, review the material related to that, review the examples on page 88 and 90, 88 through 90 of your text. You have 3 hours to take it, so that's why I'm saying you should prepare before you take it, so you're not just sitting down there wasting time trying to review before you do that. Review the problem, the third fact pattern of the problems for Class 1 and the answers that I have posted. And call or email me with any issues or concerns. I'm generally available. Please manage your time well in dealing with this, and have a great Memorial Day weekend. I do apologize. I'm feeling very under the weather today. You wouldn't believe it. And so take the assignment and email me any questions. Send me the attendance question so that I can mark you down as having attended. If there's any confusion as to what I'm asking you to do, please email me directly. Thank you, and I hope you have a great holiday.